Over the course of the last 2 weeks, we've had a lot of conversations. You heard it here, started with Senator Rounds earlier this morning about what is the next 4 years going to look like, what's it going to look like in Congress, what's it going to look like in the administration. We're all waiting with bated breath to see what happens at the Department of Treasury. I think for us, that's going to have probably one of the biggest impacts. But one of the consistent things that continues to come up is whoever is at Treasury, are we going to have someone at the head of the next FDIC that is as good as Jelena McWilliams was when she was at the head of the FDIC? And that is, you know, round of applause. I say this as someone who comes from a bank who had the ability and the opportunity over and over again to meet, to talk, to think through ideas, problems, strategies, and how do we continue to drive this ecosystem forward. And Jelena was one of the most thoughtful, pragmatic people who was always just super approachable and made sure that government was actually working for the people it's meant to work for and supporting the institutions it's meant to support. And so we are very excited, especially now, given what's happened over the last 2 weeks, knowing what's coming in the next 4 years, to hear from you and how you and everything you have to say. And so thank you very, very much. And moderated, of course, by our great friend, Chris Hilliard at Winnow Solutions. So please, come on up.
Because I need to clarify something before you start.
Yes, certainly.
Every year, Phil says this like we were buddies. Like, oh yeah, we talked, we collaborated. He stalked me at different conferences. I would land at the airport, get into the Uber, show up at the conference, I would open up the door to get out of an Uber, so this wasn't even like pre-planned, and there would be Phil standing and like wanting to talk about his issues, which were many. But anyway, so I don't want you to think it was like a buddy-buddy relationship. He was my original stalker, and then we became friends.
It's okay. If you ever want to feel small, be introduced after you. Because it was basically 5 minutes of Jelena McWilliams and then Chris Hilliard. So, you know, it's totally okay. I'm all right with it, though. Because as Phil said, we were extremely lucky to have you as chairman of the FDIC. So with that in mind, first question I would be asking is, are you on your way down to Mar-a-Lago anytime soon for a second...
So something really interesting happened last week at the Clearinghouse conference. So I was on a panel, and my plane was late. So I made a big entrance about 15 minutes late onto the panel, and the other panelists were already sitting there. And there were tweets going on, she must be late because she's at Mar-a-Lago. And I was like, I don't know, like, we'll just go with this. No. I'm very happy where I am, and a lot of things would. Well, whether or not I would go into the administration would depend on a lot of things, including, you know, there aren't many jobs left, so there's that.
So, yeah, as we're looking back and looking forward, a lot of the panels earlier, or a lot of the conversations we had earlier today have been kind of looking forward about what the new administration may bring, how they may handle certain things, who they may appoint. Do you have any just initial kind of general thoughts as to what we're going to see over the next 2 to 3 months, and then a little bit further out?
Yeah. So I think, and I don't know how much people really know how this develops in DC, but the key position for the financial regulatory space will be Treasury Secretary, even though for a number of you, Treasury Secretary's role will mean not a whole lot in terms of the regulations you get, et cetera. But once the Treasury Secretary is put in place, the director of the National Economic Council will be picked. And once that person is put in place, that's where all the candidates for the jobs get vetted. This is who you get a call from. I got a call from the NEC when I was a general counsel of the bank, and you know they were looking for candidates for different agencies. And so that's really what's going to happen. Once you have the NEC team in place, is when you are going to know a little bit more about the personalities and people that may be put into these jobs.
So, having your past experience, obviously, we're all very well familiar with it and whatnot, but having your past experience, what would you say as, in your experience as FDIC chair, shaped your purview on the balance between regulation, innovation, and financial services?
So when I went to the FDIC, I did come from a bank as a general counsel, but before that I spent 6 years on the Senate Banking Committee. And the Senate Banking Committee is the committee of jurisdiction overseeing the FDIC, the Fed, OCC, FHFA, SEC, CFTC, HUD, like I can go on with the acronyms. And I joke that every time when I go with all the acronyms, I sound like a rapper. So I'll spare you. I think for the ones that you care about are the CFPB, OCC, Fed, and FDIC. And so when I went to the FDIC, the agency was not completely new to me. I knew some of the personality, I knew some of the policies, I have read Inspector General reports, I have met with the people, we held hearings. So it wasn't a complete surprise going into the building. But I have to tell you, it was still a surprise as to how tedious, and I'll be very blunt about this. I promise, Phil, I would say something blunt. So how tedious the bureaucracy was, and how difficult it was to, even when you knew coming in what needed to be done, how to do it, et cetera, how much it would be cumbersome to move things inside the building. And I'll give you one example. Initially, when I got to the FDIC, you know, the first question, the first town hall meeting, 2 days I'm into the job, 2 days we do a town hall meeting, and one of the first question is, would the new chairman support early buyouts for retirement for people? And I was like, heck no. Why would I give you money just to go retire? Like, shouldn't you just go retire for free? You know, it's a gift to go retire, right? No, and then about 6-7 months in, I was like, how quickly can we give them the early buyout? Because like I'm trying to shapeshift, thank you for that. The shapeshift the agency into like the more modern, more open-minded, more you know, technologically savvy agency. And I can't do that with a workforce that frankly was not, you know, up to speed on a lot of most recent developments in the banking sector. And so it literally took to devise a plan, to negotiate a plan with the union, to get the plan through the PPO, Presidential Personnel Office, through the OMB, Office of Management and Budget, to get the requisite approvals, make sure that you're complying with all the requisite laws, et cetera. It took between 11 and 13 months to just get the approval to do the buyouts and send people into early retirement. And then when we announced it, it was January of 2020. And then the pandemic broke out, and then I got politically attacked for wanting to offer up the early retirement to some people. And we were very targeted. No examiner would qualify. It was about 1,200 people out of 6,000 workforce could avail themselves of this retirement. This was all carefully negotiated. But then I got politically attacked for wanting to get rid of, I think one of the members of Congress tweeted, I was trying to get rid of all of the people who are not on board with the Trump agenda and hire 1,200 people who are on board with the Trump agenda. And I'm just sitting there saying, I would like to find 1,200 people who know banking and could be possibly on board with the Trump agenda, but like we're just going to do this the right way. So anyway, so we had to suspend the buyout. And then I got attacked for suspending the buyout. So you can't win. So you want to ask me again if I want to go back into the administration?
No,
okay, yes,
no.
I'm just telling you, there's like no winning.
I think we're good on that one. That's
Yeah, all
fine.
right.
You know, in fact, they're not going to offer it to me, so I'm not going to take it either. So no worries.
No, well, I'm glad we're aligned. Yes.
So knowing the headwinds that you faced, are there particular shifts or priorities you anticipate under this administration that is going to impact fintech and financial institutions specifically?
So I think you'll have a lot more open-mindedness. And this is not to say that they're not going to follow the laws and regulations, they're going to be easy on compliance or examination or supervision. I just think the approach will shift to more of an open dialogue. I do think a lot of folks who were in the prior Trump administration in these jobs do have concerns about whether or not, people call it Operation Choke Point 2.0, targeted fintechs, crypto, et cetera, but I know now that I'm a lawyer on the outside how difficult it has been for both the fintech clients, crypto clients, to find third-party relationships, and in some cases even just a plain banking relationship, like a depository account relationship. And then I know how difficult it has been for banks to navigate that space and how much money they have spent. So I do think there's going to be just generally more openness.
Do you think there's an opportunity for having any type of meaningful bipartisan support of something? Here's the quote that's going to go in the...
No, which is why I'm carefully thinking what I'm going to say.
I'm hoping you're not carefully thinking.
What is? I'm kidding. That was not. That was a joke. I would say that hopefully that's the case, and I think if people are really smart about what this is and isn't, the most recent election, I think the country wanted to do a space shift, basically change a lot of things, and I think that United States has to have a pro-business environment. We're the world's leading economy, and we're not going to be that for a long time if we're not, pro-business. Developments in innovation should not happen outside of the United States. They should happen here. We should be wise about it. We should regulate it appropriately, but we should let it, blossom in the United States. So I'm hoping that people will see that, and that, politics aside, we will be able to get to the finish line on where we need to get.
Kind of moving along in that collaborative nature you talked about earlier, how do you think that regulators can better engage with the private sector to understand emerging technologies and how to potentially regulate those emerging technologies?
Honestly, people talk about this, and it's a great question, as if it's like a Herculean lift, the labor of Sisyphus, you roll that rock and it comes back. No, it doesn't. You basically just reach out to people and have meetings. And I do remember that my first few months on the job, I reached out to folks in the industry and said, hey, schedule me some meetings. I'm curious to learn about, I'm curious to learn about this development, that development. And I did. I went on a listening tour, basically meeting with banks, fintechs, third-party providers, folks who are, consumers, everybody, just to kind of get to understand where are the choke points in the system that are not allowing people to either get access to credit or the banks not to offer certain products and services, fintechs to enter the ecosystem in a responsible manner, et cetera. So just schedule meetings and go talk to people. It's not that hard. I mean, it sounds too simple, but it's true. Just pick up a phone and, I'll tell you this, when the pandemic broke out, I picked up the phone and called the CEOs of the 10 largest banks that the FDIC supervises. And I said, okay, the economy is shutting down. Local business ordinances are telling businesses not to open up. We're all in this work from home environment. So who's going to suffer? The hourly wage workers are going to suffer, and they won't be able to make their bills. So what do you need from us to make sure that you can continue to offer credit and not put those people in foreclosure, et cetera, et cetera? And inevitably, all of them, gave good advice. And one of the good advice that was given was that we want to modify loans, but we can't modify them because under the GAAP, the general accounting principles, that any loan that gets modified becomes a trouble debt restructuring, and as such, we will have a lot of TDRs on our books, and your examiners will hate it. And so I was like, all right, let's fix that. And so you call up the person in charge of GAAP, and you say, we can do this the easy way or the hard way. That I was the original person to say that. They already were not in a good position because most of you here didn't like what they did on CECL. So they were willing to cooperate on this. And so we changed the rules for the purpose of the pandemic. So it's not that hard. You just have to be open to the dialogue, and frankly, you have to put politics aside. And I think a lot of the things we did early in the pandemic with the Fed and the OCC, we said we're going to do the right thing, and then if politically we get attacked, so be it. They're going to attack us either way. Right. So we may as well do the right thing.
Well, and pushing on that a little bit, and being a person that spent 2 years getting a bank out of an FDIC consent order, I would say
only two?
Only two. Oh, I was good.
You must be a prodigy. So.
Maybe. I don't know. Did you guys hear that? Jelena McWilliams just called me a prodigy. That's the quote for today. So pushing on that a little bit, it was always very refreshing to have that attitude and to have that style of governance and whatnot coming from your tenure there. However, it doesn't seem to necessarily always get down to the line examiners, the examiners in charge, the folks that are on the ground. How do you feel as though the person that will eventually take what were your shoes, how do you think they can get that to actually take place and have that go down to a more on the ground level where it does affect things like reports of examination and how they're understanding technology that Baz is using and that other fintechs are using, AI, all of that type of stuff?
So I'll also say, it's so easy to be on the outside, and so that's easy too. But it's not, again, it's not that hard. It's one of those things that when I got to the FDIC and I realized how many decisions were made in Washington and how many of those decisions impacted the banks on the ground, and how little, at times, folks in Washington knew of those banks on the ground, it became clear to me that we should delegate more authority to the regional offices because those examiners on the ground basically know the bank. And so what would happen in a number of cases is that the examiners on the ground would say X, generally positive, or somewhat positive, and that X would come to Washington, and then that X would be X minus, and it may be morph into Y, which is a negative. And so it was just shocking to me, like, how are we in Washington changing things from the examiners on the ground when the examiners on the ground know these banks. So I would do skip level meetings where I took out, I wouldn't include the heads of supervision on the compliance and risk management side, but I would go to their direct reports, which were the regional directors, the 6 regional directors in the United States, and then basically talk to them about what's happening on the ground. I didn't want and I wasn't being mean, you know. If I'm mean, I tell people I'm being mean, but like I really wasn't being mean. The purpose of this was not to worry about what their supervisors will say, but just to get a sense of what's happening on the ground. Oh, this is another thing where the bureaucracy will just kill you in these jobs. So I said, give me a list of delegated authorities. So I don't know how many of you know, but a lot of these agencies basically, the statute provides for all of the things to happen in Washington, D.C. And then the Washington, D.C., whether you're at the Fed or you're at the FDIC, and I think partially OCC as well, but the OCC doesn't have a board. So all of the decisions statutorily are supposed to be made, including bank supervision, are supposed to be made in Washington, D.C. Then the Washington, D.C., either the Board of Governors of the Federal Reserve System or the Board of Directors at the FDIC delegates the authority to the regional offices to supervise banks to do this and that, but it has to be done on a delegated authority. So I wanted to empower regional offices to do more, and I said to lawyers and others, I said, give me the list of delegated authorities. It literally took 9 months to put together the list of delegated authorities and put it on my desk. And I literally sat there saying, like, you could have a baby. Like, you know, in this amount of time that it took you guys to get me the list of delegated authorities and what else could be delegated. It was just a shocking. So I do think whoever comes into the job, and I'm very much so hoping it's my former deputy, who's now the vice chairman, Travis Hill, who statutorily would become the acting chairman should Mr. Grunberg resign. I'm hoping that there was a learning curve during the first 4 years, and if he is the person in the job, his learning curve is not that high. Like, he actually doesn't have a learning curve. He has a doing curve. He doesn't have a learning curve. And so I would hope that, you know, he would take the knowledge we had, we garnered together from the first, my tenure, and then make the FDIC, you know, what it needs to be in terms of all of that stuff.
And trying to put the FDIC in the forefront of innovation, and obviously, you know, that
You're
we're
putting it in the forefront.
trying to.
I did too.
Yeah, well, and we appreciate that. But we saw, you know, the first chief innovation officer of the FDIC kind of resign in frustration. Do you feel as though that role can technically succeed in that type of environment, or do you think it needs to have a paradigm shift to take place?
I'm not shopping for a chief innovation officer, but I think the new chairman of the FDIC or acting chairman will be shopping for the new head of innovation. And so I'll tell you how difficult it was to fill that job. We had 4 different postings. For each of the job postings, we had between 500 and 1,000 resumes submitted. And what I didn't want was a Washington bureaucrat. And so to find a technologist who is sitting there and thinking, do I go to the FDIC to work in this highly charged political bureaucratic morass environment, or do I take my next seed of funding to create the next big idea? It basically tells you who you're going to get for the job. And so it's an incredibly difficult job to fulfill. And I do think, depends on who's the chairman and how much emphasis they place on innovation, it is a necessity. When I left, they moved the role of the chief innovation officer under the IT division, which is absolutely the wrong thing to do. I think it needs to be taken out of the IT. It needs to report directly to the chairman. The chairman, frankly, needs to be aggressive, he or she, whoever it is, and say, you are going to change the world, and it's going to start with X, and then give them a game plan and make sure to see how it happens. One of the things we tried to do when I was at the FDIC that would have been so novel and so good, there were 2 big projects that the chief innovation officer was supposed to execute on, and then honestly, we got killed by COVID, because it was hard to do any of this in a remote working environment. But one was creating I called it the Good Housekeeping Seal of Approval. And what that was a standard setting body that would be a public-private partnership, kind of like what the Food and Drug Administration does with the food labeling and food quality assurances. They outsource that work to private labs. And so the FDIC would basically outsource or work in partnership with private labs, probably at the university or something, and do the due diligence on basic onboarding for a third party to go be onboarded with a bank. So it would say if you need to present 100 steps in a due diligence process to be onboarded with a bank, this entity, this good housekeeping seal of approval entity would do that 50, 60, 70, whatever they can that are like know your customer, anti-money laundering, et cetera, compliance, IT security. And then you would, if you're a fintech, if you're a third party, you would take that certificate, bring it to the FDIC and say, okay, we're going to be onboarded with other banks. The FDIC is basically in that process of approving that certificate. And then you take that certificate to a bank and you say, okay, you don't have to do the first 60, 70 steps. Now you only have left 20 steps based on your risk profile and business model. And so that was like one of those ideas that would have sped up so many things in the system. And imagine if you're a banker in the room having the ability to basically get the certificate, here comes FinTech A, comes to be onboarded with you, and they have a good housekeeping seal of approval from the FDIC. Like, huge.
Does that work would that have worked like a non-disapproval? Because I don't imagine that the FDIC would necessarily say, that's approved.
No, well, the FDIC would have licensed the labs.
Okay.
And so if you got a certificate from one of these labs, that means you have the blessing of the FDIC, because the FDIC would have set the standard setting procedures and the requirements for you to get certified. So just like the FDA, this wasn't brilliant, honestly. There was a precedent for this. And so something like that, I think would, when you talk about what could move the ecosystem forward, that could hugely move the ecosystem forward.
I'd be remiss if I didn't get at least one question in about this and ask you, how do you perceive the FDIC's proposed synapse rule impacting the dynamics between...
Did you have to go
I
there?
had to go there. I mean,
Do you have any other questions?
I do have other questions.
All right.
But you kind of talked on all of them, though, so I don't want to
Well, I'm
be
speaking
duplicative.
fast because, Phil gave us 25 minutes.
I know. Thanks, Phil.
Yeah.
No, so... See, that was a brilliant move. You interrupted me in the
I'm
question.
good, huh?
Yeah, very good.
Yeah.
So
Remember, I used to have to testify.
you did,
Yeah.
and I did not. So there's my
there's
disadvantage. So how do you perceive the proposed synapse rule impacting the dynamics between banks?
It's the same question.
It's the same question. I'm gonna get it, but I'm gonna get it out. I'm gonna get it out. I promise.
Okay, good for you.
Are you not
Flip the
answering
page.
it? It's okay.
No,
That's
you
fine.
have something. So here's the bottom line. Okay, I'm going to filibuster, and
just
then
a
you'll
little bit.
remember not to ask the same question again.
Noted.
So I think what is going to be really interesting, and this happens every time, and I don't think that you can, I would like to blame one side or the other because I'm a Washington insider for better or for worse, but I don't think you can blame one side or the other. But every time there is a change in the administration, two things happen. One is that if you are in the agency, there's something that's called Congressional Review Act. And Congressional Review Act, which rarely used to be used in the past when these agencies were less political. So what it does, it allows Congress to, by I believe, 2/3 vote in both chambers and the signature of the president, basically ameliorate any rule that might have been finalized by the agency within 60 session days of that vote taking place. And so when you think 60 session days, you're like, most of you are probably shuffling to a calendar. 60 session days would be 2 months. No, so I'm going to tell you a secret how your government works. The Congress is in session not Monday through Friday. Sometimes they're Monday through Friday where they need to get a budget approved, et cetera. Most often they're not in session for a while. And so in a presidential election year, they go out of session early August, and then they come back into session sometime in September, and then they're supposed to go back to their districts and campaign, so they're not in session. And so then they come back in December after Thanksgiving, and they're in session because they gotta fund the government. And so literally, I think between August and the end of the year, you will have like 12 session days in an election year. So when you count 60 session days back, usually it's May, sometimes even April from the new administration and the new Congress being sworn in and the new administration coming in. So any rule that has been promulgated by these agencies within probably since May, and in some cases even April, could be questioned by Congress. And if Congress votes on it under the Congressional Review Act, basically the agency, two things happen. That rule is void, as if it never were proposed, or I'm sorry, finalized. And the second thing that happens, the agency cannot finalize a similar rule. So they got to go back to the drawing board and do something completely different. And so when you ask me about any one rule that has been proposed by the FDIC, if it hasn't been finalized, it'll be up to the next chairman or acting chairman to decide whether to just put them on the shelf and have them like look pretty on the shelf, or whether or not, if the rules have been finalized, they would like to invoke the Congressional Review Act and then have the Congress vote on that.
Excellent. Well, I'm going to get one more question, even though we're at time. I just want to leave folks with an uplifting message. What are you hopeful for in the coming administration, in the coming years, on the interplay between regulators and financial innovation, fintechs, and financial institutions?
Yeah. So I'm really, I don't hope like I do. So where I really hope we go with this reset is to a more reasonable relationship. We're not enemies, and we should not be perceived as enemies. You shouldn't perceive the regulators as the enemy, and the regulators shouldn't perceive you as the enemy, the industry. And so how do you get to a place where you have raised the level of trust to have a relationship where when you come to me, I don't automatically think you did something wrong. And I gave this in I said this in one of my first speeches at the FDIC, and then I got called out for that politically too. But I said, I clean my own house. I've never had a cleaning person come and clean my own house. Blame the immigrant mentality, right? And then you just don't buy a big house. But I have 2 white dogs, and anytime I clean the house and I go back up the stairs, I see white dog hair, like 1 or 2 strands over there. And so if you go looking for white dog hair anywhere, you're going to find it, right? So the job is not to go look for white dog hair. Like the job is to go see if the house is dirty. And my house is not dirty. Will you find dog hair? Yes, you will find dog hair. And so then once you find the dog hair, the question is the house dirty? But don't walk into that scenario thinking the house is dirty. And so I do hope there is going to be a reset where we can have an open dialogue. In the end, all with a view of helping prosper, the low and moderate income people in the United States, the moving forward technology, making sure our GDP growth is, reflected in how we look at regulations, and that we all have a common goal.
Excellent. Jelena McWilliams, everyone.
No, thank you.